Physical due diligence is not enough. You have to move to next stage. Remember, you've done your underwriting before you even did your LOI and you had a green light. But now you're going to go really, really in depth because it's possible that they didn't completely give you all the information. Because you've not signed documents with them, they are not obligated to give you many items. And if you see discrepancies, cry out loud. If it's something that they can remedy, or if it's something that they'll be able to remedy before you close, then you have to have an addendum. It's not words of mouth. So while we are doing the walkthrough, we're checking the unit, we're checking the layout size because we also want to confirm the size. Like I said in one previous video, you want to be sure that the square footage that was mentioned is the same as what they told you in the OM. OM is the offering memorandum, is a book or a summary of the property that the broker would have presented to you at the beginning. So they will write the square foot of the units and all that. So while you're doing your walkthrough, you're confirming, is that really the size? Because multifamily is charged by square foot. So if they told you the square foot is 800 and you came in, you measured it to 600, that is 200 square foot, and that is a lot of dollars that you are going to lose because you will never get the rent for an 800 square foot that you were promised. You will never get it at all. It happened to us on, this was a single family that we bought though. They told us that that property was, I want to just put a figure, let's say 2100 square foot. So the appraiser came, measured it, and they found out that it was 1800. Because of that, 20,000 or so was renegotiated because of that. And it's also applicable to the multifamily. If the square foot is not same as what they said, possibly you might not get that rent. So those are things you also look out for. We go to the bathroom, we check all the fittings, everything to know the ones we will change. The kitchen, we'll also check if, even though the kitchen is fine, we also want to check if it's up to standard to know what kind of renovations we want to do. But before we even do that, we also want to know what the market is doing and to see if the market is doing that, and if we do it, if we'll be able to increase rent and all that. I always tell people, don't do renovations on your property if it's not going to give you return on investment. Not because your neighbor is doing it, that's why you should do it. If you're going to do it, it should be because you can increase rent for it. There's nothing like, I want my house to be the prettiest in town. There's no pretty. No, cannot be the prettiest, but neither should it be the worst. Bottom line is, have the ability to always maintain your unit, but does not mean that you should take it overboard. So we are also assessing what kind of renovations we want to do on that particular property. Like I said, it's not one size fits all. We are looking at from the worst. So we always grade all the properties from 1 to 5. 1 means that this one needs a full-time job. 5 means that it's in a good condition. We necessarily might not put in anything, or even if we put in something, 1 or 2. So we have a score sheet for all the units. With that, we're able to create an average of what each unit will require. It's very important. These are things you should be doing with your contractor or your property manager. Or it's important you know the process so that when they are not doing it right, you can correct them. Say, no, go do this. But it does not mean that you're the one doing it. They're doing it, but you're also inspecting them. And those things they are doing, are you going to take those reports, and you as the buyer, you're going to form your business plan around it. Because it's based on what you're saying. That is how your business plan comes to being. Because you're also asking the tenants, what would you like to have that you don't have? And they're telling you, oh, I have kids, we don't have playground. If we can have a playground, that would be good for us. That's an idea for you. When you ask 1 or 2, 3, and they're telling you the same thing, that means that's a value add. And you are not going to just ask them and say, if we have it, can you pay for it? Sorry, so we can pay for it. That shows you something, that there's something there. It's very important you go through that process. It gives you an idea of what the business plan will be. While you're signing your PSA, there's a part of the PSA that has an addendum or exhibit. They call it exhibit A or B. That exhibit A or B is a list of due diligence items that you are requesting from the seller. So the seller will propose to you his own due diligence item. I always counter it because I'll add mine to it. I want this and this. I need more of it. But the more you are, there are some standard checklists for your due diligence items. Things like the rent roll, you need to have the rent roll, the T12. T12 is profit and loss, guys. 12 months profit and loss. That's what it is. You're asking for the previous survey. You're asking for the layout. The main things you're asking for loss runs. Loss runs is an insurance report that tells you if they've had losses on the property and if they have any claim. Because if they do, it might affect your insurance quotes. So these are things you're asking for. I'm also asking every month, I need to see their finances every month. I always include it there in my PSA. For the fact you're giving me at the beginning, I need to see it every month because I always want to know what is happening, because it's possible that while you sign the contract, the seller says, oh, I'm selling. So he takes his hands off the property, and the property that was less than 95% now becomes 60% at the time you are taking it over. You don't want to do that. So you also want to make them responsible for them to do the right thing. So that checklist, you have all your financials, you've asked them to provide it. You've asked them to provide warranties, you've asked them to provide contracts, vendors that they've used. I always ask for inventories because it's part of the property I'm buying. I'm asking for inventories because these things are expensive. I'm looking for maybe parts of ACs that they have in their store. I'm looking for paints that they've used that they've not finished. These things cost money. So if I have access to it, it saves me money. So I'm also requesting for a list of inventories. Everything, including the hammer, spanner, even to nails or screws. I'm asking for how many do you have? Because if you don't give me, I'm going to buy it. But I'm buying the property and this is a part of the property. So it's mine. There's a property that will close down. The property came with a shuttle. Thank God at the beginning we asked for inventory. So they put it there. That was part of the inventory. When we closed, the seller sent someone to come and pick the shuttle. And I said, no, that's part of the inventory. He said, no, it's not part of it. I said, okay, this is the inventory. We showed it to him and the proof. And he said, oh, I didn't know I put it in there. I said, okay. That was how the case died, a natural death. So you need to ask for the inventory at the beginning, because I've seen sellers that are closing, they're going to empty the property. Even to the chairs and tables in the leasing office, they will take it all. So you don't want that to happen. So after going through the property, now you're going back to the financials. Remember, the first thing I've done is the physical due diligence. That is when I'm inspecting the property, doing the roof and all that, the interior. Those are called physical due diligence. Physical due diligence is not enough. You have to move to next stage. Remember, you've done your underwriting before you even did your LOI and you had a green light. But now you're going to go really, really in depth, because it's possible that they didn't completely give you all the information. Because you've not signed at the beginning, you did not sign documents with them. They are not obligated to give you many items. Things like their general ledgers, things like bank statements, things like their tax schedules. They are not obligated to give it to you. But if you have those things in your due diligence items at the beginning before you sign your PSA, they are more than obligated to give it. And if they don't give it to you, then they are in breach of the contract. So it's at this point you are opening them up. Now you are doing a proper due diligence. For the fact you signed PSA, you've done all those things, does not mean that you cannot walk out. It's periods like this that people walk away from the deal because the canker worm is opened. Things that they did not tell you. You will see discrepancies of the highest degree then and then. So you have to be very careful. Take your time. Work with your property manager. Go through it. And if you see discrepancies, cry out loud. If it's something that they can remedy, or if it's something that they'll be able to remedy before you close, then you have to have an addendum. It's not words of mouth. So let's say, for example, during my due diligence, I noticed that what you told me is different from what I'm saying. Let me say, you told me that your roofs were just recently replaced. And during the due diligence, I got access to the receipts of the roof or more information about the roof. And I found out that no, this roof 10 years old, not even 1 year. That is high discrepancy. I'm going to put it to you that is either you give me a credit or we retrade. Retrade means that if that deal was supposed to be 5 million, because I'm changing the roof, I have to reprice it. It's going to be maybe 4 million or 4.5 because I have to change the roof. You gave me wrong information at the beginning. So it's either you give me credit or I retrade or you do the repairs. Those are the three options. So it's going to be a battle between you and the seller. It's up to your negotiating skill at that point. Like I said, is give and take. Pick your battles. If the seller is willing to do 50% of it and the deal still works for you, maybe you go ahead and continue. So you have to check the numbers. But if the seller is saying, I will do it, then the next question, if you're going to do it, it must be up to this standard and I will inspect it. In our last deal that we closed, we gave him a quote that this is the price of doing the repair. Let's say the quote was 50,000. He came and said it was going to give us 9,000. 9,000 to do the job. And I said, no, go do the job, but it must be up to the standard. So he did it. He spent more than that. Before we closed, we went to inspect it and it was good. We inspected it. Only 1 or 2 was not good, rejected it, and he repaired it before we finally closed. So you have different options. You can retrade. You can ask for a credit at closing. He gave us credit at 25,000 at closing. He did the repairs. He didn't allow us to retrade. That was the only thing we didn't get, but I tried. We were on it, as in, I gave it to him, but I didn't win that battle. But yeah, but at least we got something off the table. Why I accepted not to retrade was because the property was even performing better than how we got it before we signed the contract. He said, Bibi, I got this deal when the NOI was at this. Now the NOI is at this. So I've used up equity for you on this deal. So I'm not going to retrade. If I take you back to the market based on my new NOI, I'm going to sell it better. So I'm not going to retrade. And I saw reasons with him. That's why I just said, okay, fine, no problem. And that was it. So that's how we let that. So while you're doing that, let's say you finish your financials, pans out, is good. You move away from that. In your financials, you're checking out the rent roll. You're checking out the T12, the profit and loss. You're checking out the age receivables, the delinquency reports. For the fact that the numbers looks good on the T12, you also need to know the age receivables. Why is that very important? You want to know how early they pay or whether they even pay at all. Because when you look at the age receivables, you'll be able to tell what kind of tenants are this. If they are bad tenants don't pay rent or they pay very late. If you see a significant amount of tenants owing month to month, please just take your bag and run away. Leave it. Just run away, because it means that you have to evict almost the entire unit and bring in better tenants for that to happen. But that's not the kind of business plan you want to do. Except that is your business plan, that you want to take out the entire tenant and bring in new ones. I wish you all the best if that's your business plan. But for us, that's not our business plan. We want to carry on minimal risk, something that can easily stabilize and move forward. Not something that will take us 2 years to turn. No, that's not it. So the age receivable will tell you exactly who your tenants are. Because when you see they're owing a lot month to month, then that's a red light that you have bad tenants on this property. I know that. But when you see one or two, there's almost impossible for it to be zero. Most times you might see one or two people owing. But just look at the trend, because we also want to look at the trend. I always ask for 2 years age receivable. I want to see the trend from 2 years ago. How are the tenants performing? How are they doing to date? And I also want to see the trends of the rent roll. How has the occupancy been month to month for the last 2 years? I also want to see what their profit and loss has been for the last 2 years. Because it's possible that because they are selling, they are creating all kind of scenarios for you, and maybe the last 6 months before you put it under contract is their best month ever. If that is the case, then you need to look back and know what they've been doing for the last 2 or 3 years to know if this is sustainable, if they're just filling in some things that you just need to be aware of. Because what I would normally ask, you were here at this point, now you are here, what changed? Why the improvement? Why didn't you have this improvement 1 year ago? And so they will come up with a tangible excuse. Some will come up with the occupancy increased, so we had to So you have to just be careful, because those are the things that will give you questions, because you need to also go back and ask the seller some questions from the T12, from those things that you are assessing or you are underwriting. It will give you more questions to ask, because you need to ask, why did this change at this point? What happened between here and here? The thing is, on a T12, when I look at the trend, I can see an interpretation. Like, there's something called gross potential income. It means that it's a potential, or that's the market rate, or that is where the market is currently at. If it was 120 in January, 125 in February, and it goes down to 110 in March, it means the market has shifted. It means the market has come down. So when I see those trends, I ask questions. We can't control how the market is performing. But in a case whereby the market is at that level and I'm seeing their rent roll maybe for January was, let's say, 120. In February, it declined by 110. I'm asking questions. Why did your rent reduce from 120 to 110? I know the answer, but I want to hear from the property manager. And this is the typical answer. Oh, we reduced rent because the market has cooled off. Or because our vacancy was a little high, we needed more people to come in, so we had to reduce our rent. So now the next question I'm going to ask them, was your rent above the market? No, it was not above the market. Then the next question I'm asking is, were there pushbacks? If there are pushbacks, if they tell me, oh yeah, some property managers are very sincere. Yes, some of them were pushing back on it, so we needed to change the amount and all that. Then what that tells me is that I go back to my projections to see what is my rent, because they're already pushing back on it here. So if I said my rent is 110 and they're pushing back for 110, that means I will not be able to achieve 110. That means my projection should be either $100 or $95. So those things will kind of give you an idea of what exactly is happening. But if I see a trend whereby it keeps going up and they keep increasing, the loss to lease is going down, that means the tenants are absorbing it. No issues. They're not pushing back, they're taking it. That means it's possible that my business plan can be achieved. So I look at so many things in T12. But don't get it twisted. It's not one day journey. I've been in this field since 2009. I can tell you for a fact that how I started is not the same way I am right now. The years and experience has built me up to have the eyes to see see all these things. So don't push it. Don't be hard on yourself. The more you do it, the more you'll be able to identify different tricks. I wouldn't like to, every time I'm looking at a deal, I'm having a different interpretation. I'm seeing new things that in a previous deal I might not have seen. So the more you keep doing it, the more exposed you become and the more experienced you'll be and all that. But I'm just giving you the layout. It's a continuous process till you finish. So invariably, once you finish your due diligence, you've checked everything checks out, you have maybe 60 more days for you to close. While you're closing, some of us are taking that time to raise money. Don't be distracted. While you are raising money for the deal and doing other trivial stuff, monitor the deal that you are buying. You're monitoring the rent roll. You're trying to see if they're keeping up with vacancies, occupancies, and the rent growth. You want to see if the rent is still growing. Then the T12, you're trying to see if they're building up on your net operating income. You're trying to see what is actually currently eating up the expenses. You're trying to see what are the ways I can improve on what they're currently doing. And you're trying to see if they're not going to hand over an empty property to you at the end. So you have to do this process till the day you close. And after you close, there's a new continuation. We call it asset management. For me, it's another due diligence again. But that one, you're not the owner. You're checking yourself to see if you're on track with what you're doing. So that one is a target on you. The other one is a target on the deal and the seller and other things. So in summary, it's not a one-day conversation, but I hope that with what we've spoken, you would have picked one or two things from what I've said. Thank you all.